I think we're about to see a lot of blood on the streets again because you have a lot of mortgages renewing in the next few months, and the renewals that are going to be coming in right now, nobody is ready for this right now.
Welcome to Supply and Demand with Adam Nadler. This is a podcast dedicated to the real estate market in Canada, available now on YouTube, Apple Music, and Spotify.
Yeah, but this time I want like something that can push to 300, not 250. Let's go. I'll go all the way.
Jesus Christ, man. Do you feel like your life is flashing before your
When
eyes?
you go to 50 to 60, you can feel that there is no friction between you and the ground. So if you had to stop, you can't.
Jesus Christ.
So at 300, I can only imagine.
And is the Autobahn very busy or no?
Some parts. But nobody drives in the left lane. It's pretty much just like a straight line. Nobody dares because people are going 300 kilometers an hour. What are you doing in the left lane? It's not like here. Here people are just like chilling, right? Coasting in the left lane. There, they see you from 2 miles away, they move. Go out of the way.
The left lane is reserved for the...
Left lane is only for passing or like speeding the hell through.
Right,
So
it's
when
reserved for the psychopaths of the world.
I was driving, there was myself and there was an aide behind me who was driving just as fast as me, and we just kept like passing each other on the way to Berlin, just trying to overtake. It was fun.
Jesus.
Yeah, 250 is a very special feeling.
I'm not sure it's a special feeling that I'd like to feel. I'm not
It's
sure.
totally worth it.
Is it?
Totally worth it.
Well, we are rolling, so I need to ask you,
Yes.
what the hell's going on with the market? I'm seeing like headlines that are basically either doom or gloom or everything's on fire.
Yeah, it's springtime, and this is where things pick up, and we see a little more dynamic happening, more so than during the last quarter of 2023, where things were very slow and almost dead in some segments. And as the spring market is here, as interest rates have finally improved for the longer term contracts, so I'm starting to get approvals below 5% on 5-year terms for the first time since last spring. That's like a good development, I think. Short-term debt is still quite expensive, so people who are buying into the market right now, I think they're all hoping that if they are taking, let's say, a 3-year term, that they will have an opportunity to get a better interest rate at the time of renewal. But I think people are starting to realize that the crash that everyone was talking about, that everybody was, well, not everybody was hoping for it. Let's rephrase that. A lot of people were hoping for it. It's not really here, and in order for it to happen, these conditions that we're in right now in terms of high interest rate, right, lack of buyers or lack of the same number of buyers as we had just a couple of years ago, in order for market to crash to the degree that people are talking about, things have to stay under the same tension for a very long time. And when I say a very long time, like I'm talking maybe another 18 to 24 months of the same level of interest rates. Let all mortgages renew that have not been renewed yet, and then let's see what actually stands. But I think that what's going to happen really is we'll see probably interest rates remain more or less the same for short-term debt for the next little while. We'll probably see some rate discounts for Bank of Canada later this year. I do hope, probably early next year. I think that's not almost a given, but it's a sure prediction. And as those things unfold, and as people see a little bit of that light at the end of the tunnel, I think market will stabilize, right, and bounce back toward the trajectory it was on before the interest rate hike started. It just maybe not to the same craziness, because I don't think we'll see interest rates hit 1.5%, 2% for a very long time. Maybe not a time that I'm going to see in my lifetime, but hopefully I'm wrong. So if the interest rates stay in that 4% mark, I think things will stabilize to a norm that we can accept.
And talk to me about immigration. That's something that is a really big deal, which we are not prepared for. In fact, I saw a CBC headline actually just, I think it was last week. It said we had just passed 41 million, where it seemed like 6 months ago, the headline was we just passed 40 million.
Yeah, well, the housing issue that has to do with like the rental issue is not gone. Rents deflated a little bit in some parts of the market, some segments of the market, but for the most part, there's still only so many units of housing available for rent, and I think that just the other thing is that also, in terms of just different types of properties, right? Like rentals, individual rentals are very expensive. And I think that what a lot of people are trying to do now more than before, not that this wasn't a model before that people used, but like sharing of the rental cost, right? If we see that, let's say, before everybody was really focused on getting a single rental for themselves, I think that it's become quite common to share rental units between people, which helps to a degree. But the single rentals, there is no more number of units. So there's been some condos have been finished in the last year, which helps. Like it provided additional housing in the city of Toronto specifically. Again, there's not a lot of condos being developed outside of Toronto, like a few here and there. But if you look at, let's say, rentals in other parts, in other markets, let's say Kitchener, Hamilton, Waterloo, Cambridge, like outside of the city core, the cost of rentals there has gone down as well. Question becomes like, why is it that way? Is it that we have less people looking for rent? Well, the answer is no, but people are looking for rent all the time. It's that I think people who are looking for rent now that they have tasted how expensive the market was in the previous 18 months, a lot of them, and this is also just from talking to people on the street essentially, right? A lot of them are looking at rentals that are larger. They can then parcel out into, let's say, 3 separate units and then share the cost of rentals in that sense. So people are looking at rentals of houses in a lot of cases, whereas before they were focused on just getting something of their own, which is like also an interesting cultural development that we have accepted that as a reality in 2020s, whereas, in 2010s, people were really focused on having their own place, where in 2020s the focus has shifted from, well, I probably can't afford my own place, but maybe I can afford a place with a couple of friends, which is another development for purchases as well, right? Like this is happening both in rental and the purchase market. So it's something, it's like a sign of things to come. But in terms of overall number of housing, it's still a problem. And it's not a problem we're going to fix anytime soon.
You do a fair bit of volume.
Mm-hmm.
And so you see a lot of applications come your way. How many people are you seeing trying to get into the housing market that are part of this wave of immigration that we've seen over the last couple of years? Are they still trying to build credit? They're not quite there yet?
Fair amount. It's just the unfortunate part is that when they start looking into this topic, they get crushed by the reality of what it takes.
What do you mean?
If in I remember when I first came to Canada in 2007, and my mom and I, we lived in a condo in North York, and those condos were sold at like 170 to 200,000 for like a 1+1 maybe. Not a bad price in 2007. It was not a very developed area at the time. But like those same condos today are worth 600,000, maybe 650. Maybe you can get a deal at 550 if you get lucky. But like to qualify for that kind of a purchase, it does take about $130,000, $140,000 worth of income with like minimal down payment, right? In 25-year M. How many immigrants do you know that come to this country and they can actually show that much income on their T1 general? Like there are some, there's few. A lot of them are probably in the tech sector. But most don't make that kind of money. Like it still is the reality of 2020 is that most households in general make only about that much to live off of. So for a single person to be able to pull that kind of income together when they just land in Canada is very difficult. So what a lot of the time will happen, and this is kind of the sales cycle for myself and people who are new to Canada, is I'll get introduced to somebody who is fresh to Canada, and then I'll have a chance to explain to them this problem. Once they understand the problem, then this is where the gears start turning. So they start also thinking outside of the box because they understand that this is an issue, but I also try not to discourage them by this issue. And nonetheless, as discouraging as it is, there are ways, right? So one of the things is we always talk about with people who are new to Canada, who are looking to buy for the first time, is the down payment that they have available for this purchase. So, and this is a conversation that's common amongst all segments of the market. It's just that if you are in a position to come up with 20% down payment, there are significantly more programs available to you in terms of financing. right? So if you're buying into a property here in Canada with less than 20% down, then you are bound by CMHC insurance or Sagan or Canada Guarantee. Why is this important? Well, because if it's somebody who is new to Canada and they're looking to buy their first home and they have the 20% down payment, it could be from their own savings, could be from parents from overseas. That's also okay. It just have to clear the money here in Canada, make sure it's been here for a fair amount of time. There are some requirements for what that time is. But if you're able to get 20% down payment and you have a reasonable amount of income, you're earning that $120,000, $130,000 worth of income. Well, now your ability to purchase something of value, and you can maybe even share this property that you're buying with one of your siblings. This is also one of the strategies, is to say, okay, well, if I have 20% down, what other programs do I have available to me besides CMHC insured programs that use 25-year AM? Can I get 30-year AM? Can I get 35-year AM, right? Can I get extended debt servicing ratios? And can I use maybe any auxiliary units in this property that I'm about to buy as additional income to qualify? That's step number one. It's being able to understand for these immigrants, for these people who are coming to Canada, trying to start a new life here, what does it take on their own, first of all, with 20% down? Or what does it take on their own with less than 20% down? Maybe because that they're bound by those requirements, by those sort of parameters. Then once we figure out this limit of what we can work with, if it is not enough, I'll give you an example. Let's say the customer is making $60,000, $70,000, $80,000, right? And that only qualifies you for about maybe, I don't know, 300 something, $400,000 worth of a mortgage. It's really not a lot, right? In the context of Toronto specifically. So let's say if you have that limitation, but you have the 20% down, and yes, you can go and get like a little bit more expensive loan, but have a little bit more room. What else can you do? Well, as I said earlier, you can maybe use a sibling to help you qualify for that purchase and maybe get a little bit of a bigger place and be able to service the mortgage, be able to qualify for it at the better interest rates, and then be able to carry it moving forward. So it's like, so you could look at exceptions based on 20% down payment. That's one. Two, you can look at siblings, or you can also say friends or common law partners or parents, or basically essentially anybody who is willing to join you on this project, on this adventure, and be a part to it as a co-signer, right? So that's also a really powerful way of doing it. And sometimes those two things work out, but sometimes they don't. Sometimes the person will say, well, I don't have 20% down payment, I have like 10. And well, I don't have anybody to co-sign and no siblings and no interested parties to join me. I only have me, and I only have this to work with. In those cases, the question becomes, okay, number one, how aggressively can you save in terms of your down payment to bring yourself up to the 20% mark so that maybe down the road we can qualify you for programs that allow you to buy what you want? And also, the other alternative is, do you need to be in a city, or can you look outside of the city for maybe purchases that are a little bit less expensive? And I had a great conversation with one of my customers recently who was looking to sort of retire more or less. And he was talking to me about buying a house somewhere out towards Chatham, right? If we're in Ontario, you know roughly where Chatham is. It's not close to Toronto. It's like 5 hours away towards Detroit. And so I asked the question, I said, why? Why Chatham? It's like 5 hours away. And he said, well, it's inexpensive, right? I can buy a house for $350. It could be a very nice, very well renovated home. And because I work remotely, although I am looking to retire at some point in the near future, what does it matter if I'm in Toronto or if I'm in Chatham, for example?
Can I ask you something though?
Sure.
I was talking to one of my brother's in-laws over the weekend. We were just chatting at a family event, and what he said to me was very interesting. It's something that I hear a lot of, which is none of this makes any sense. That this market doesn't make any sense. Nothing makes sense here. And I couldn't disagree with him. I was like, yeah, you know what? It doesn't make sense. And what you're giving us is kind of an inside look at the technical details of how you make it make sense. And one of the things that we talked about was how banks, not just mortgage brokers, because you guys are the people who are putting together files to actually pitch to underwriters, right? Banks themselves, if the numbers don't make sense, they make them make sense. They lobby for changes at the regulatory level so that things will make sense. for example, extending amortization periods, right? There should be, or I guess there have been caps on that, and they just keep getting pushed out further and further to create essentially forever loans. And that doesn't seem to matter to Canadians. All that matters to them is a monthly payment. So how far out do you think that goes? Like, how much does pricing need to increase to the point where banks just say, well, let's make the new norm a 35 or a 40-year amortization when I started in real estate, a 20-year amortization was very normal.
Well, I think it's more like surprising thing about regulatory environment in Canada is although it is getting tighter, like things are getting more regulated, and we're seeing a lot more safeguards, all around from FISRA, from federal government. It seems that it is never going in one direction. So it's not like the system is continuously getting tighter and tighter and tighter, although visually it may appear that way. But while the system is getting tighter and tighter and tighter, it does have a little bit of give, right? And so what you're referring to is that a little bit of give. So, like for example, I remember when I was starting out in mortgage brokering in the early 2010s, we still had 0% down payment. That was the thing. There is no more 0% down payment today. And the reason for that is because historically it's proven to be quite risky, because you have nothing invested in the property, then what the hell, why can't you just walk away from it if you don't want it anymore, right? Simple logic. And then we had things like we had 90% loan to value or 95% loan to value. That was a thing as well. Not insured. This was not insured before 2017, before the stress came into play. And then, and then the stress came into play. And then some other regulatory changes happened. And then as things started to get really tight during the rate hike announcements in the last 18 months, this is where the lenders, who are essentially making money and operating off of the profits that they make every year, hungry and unable to make enough volume to justify the employees that they have in the offices, right? Start to say, okay, well, what if we go step a little bit outside of the regular framework that you're looking at? What if we look at some private money and we pull the private money into the institutional space, and what we use that money to lend? Would you care, right? And so the lenders started to get creative as to how they approach the regulatory framework from, for example, FISRA or OFSFI. And that is where we saw things like 40-year AM. It was just around like a year ago. We had Haven Tree Bank offering 40-year AM. Equitable Bank came out with 35 and 40-year AM products. That was awesome, right? And for a little while, that was a way of us getting some of those deals done where things were quite tight. Now, then as more lenders started to do it, they started to use the same sort of gimmick to get that same money to be able to fund these mortgages. The regulator came out and say, hey, 1 minute, that's stepping a little bit too far outside of what we said. We didn't say this is okay. We want this to stop. And then they come back and they tighten it again. So it's this constant game of cat and mouse where you have the regulatory body continuously trying to tighten the whole thing, occasionally loosening it up a little bit here and there, trying to help. Like, for example, one of the things was that hidden guideline / misunderstood guideline that they announced last year, where they said that if you're transferring a mortgage that was insured, you can qualify it at the same contract rate that you got. That's something that everybody sort of forgot or didn't see for a little while, right? But they pointed it out and they helped us understand that is something that you should be looking to do, because why not? It's already in the guidelines announced by OSFI. So it's a game of cat and mouse. It's never one way. It is always a little bit both ways. Probably more like 65-35 in the direction of tightening, and 35 in direction of giving a little bit and loosening up a little bit. And that is why it's so hard for consumers to understand it, right? Like, it takes us, the mortgage brokers and banks and financing professionals, time to adjust to these changes, and they happen every few months. So when you're talking to a mortgage broker and the mortgage broker starts talking about insured and insurable and uninsurable and B lenders and credit unions and federally regulated and provisionally regulated and privates and semi-private, like there's just so much, right? So as a consumer, I would highly sorry, as I'm talking to consumers who are hopefully watching this right now, you shouldn't be trying to make sense of the programs as much as you should be trying to align yourself with people who do this all the time, right? Because to what you were asking me earlier, how do you deal with new to Canada applicants, for example? I deal with them by first and foremost announcing at the very beginning of the conversation that it's not unlikely that we will talk about this right now and that nothing might happen right away, right? Because the reality is that home ownership and home purchasing is a project that sometimes takes quite a bit of time. And so, but the important thing is that you have found somebody who does this all day. So even if we can't do this right now, I will 100% explain to you how to get there. And in most cases, that takes away a lot of anxiety because when the customer is first talking to a mortgage broker or a bank, they're not sure if they can do what they're about to do. And that is really stressful. And it's even just a hard conversation to have for a lot of them because they're fearful of what they're about to find out. And so when they are meeting somebody who says, hey, don't worry, this could take a little longer than you think, but that's also okay, right? But it's like you are in the right place. This is where you start. And then if we can do it right now, we'll figure out a way of how to get there. And most of the time, that is precisely the kind of attitude they need to be able to approach homeownership. And that could mean like working on their credit or working on their down payment, maybe waiting for the raise to kick in that they're waiting for, maybe waiting for their sibling to arrive who is also going to be making money in Canada and who will make material impact to the mortgage application. And that is how you do it.
So in terms, I guess, of the actual overall grasp of the market and what's happening right now, we've definitely passed the worst of it. But it seems like we're not out of the woods yet.
It depends what you mean, like the worst of it. The worst of it in terms of rate hikes, I think we have. The worst of it in terms of what's about to happen, let's say this summer, I don't think we have. I think we're about to see a lot of blood on the streets again because you have a lot of mortgages renewing in the next few months. And the renewals that are going to be coming in right now, nobody is ready for this right now.
And how are banks going to prepare for that? Because it's not like banks are excited about foreclosing on people. They don't want to do that.
No, we're not talking about foreclosures yet. So remember how a few podcasts ago, we talked about what it takes, how long it takes for people to default after the interest rate materially changes from what they are used to. Because like when you live on a certain budget, like you use a certain payment a month, right? And then the interest rate hikes happened. And for a lot of those variable rate mortgages, payments have changed already a long time ago. So those have already been feeling it. Excuse me. But the renewals that are about to happen in the next 2 quarters, those people haven't felt it yet. They've heard about it. They haven't experienced what it actually feels like to have a mortgage at like 5 or 6% interest rate.
But wouldn't that happen more in 2025? Because really interest rates dropped in 2020.
But not a lot of them like a lot of people bought in 2022 and then they got like a 2-year term. Or in 2021 they got a 3-year term. They got in 2019 and they got a 5-year term. Like these are all coming due now. I remember in 2019 I was closing like most of my mortgages were 5-year terms. I maybe did like a fraction of them that were like maybe 2 or 3 or 4. But it would only be typically because of some sort of rate specials or something. It would typically be 5. Like most stuff that would close in 2019 was all 5-year terms. 2018 was mostly 5-year terms. 2020 was 5-year terms. It was 2021 when we're closing a lot of variable rate mortgages, actually 2020 as well. And those were often 5-year terms, but those are variable. A lot of them gotten converted into fixed since. So those people have felt the pain and they have been dealing with it. But it's the ones that haven't, is the ones whose mortgages have been fixed this whole time, and they're coming due for renewal now, right? And so those mortgages that were in 2019, for example, were probably fixed at like 3% interest rate or 2.5% interest rate. Like right now, they're going to be looking at 5.5, maybe 6 in some cases, depending what the
But on a smaller principal though.
Sure, to a degree, it's still smaller. But if you got a mortgage of $1 million in 2019, it's not like it's going to be 300,000 today. It's going to be still like in the 800,000 to 900,000 range, depending how aggressively you were paying down your principal. So it's like those rentals, if they're rentals, none of them will make any sense because they'll all renew and they'll all be cash flow negative, and not a lot of people will have the deep enough pockets to be able to carry them. So you will see a resurgence of more listings.
Well, that we've already seen, and I
Yeah.
can speak to that because I know I'm watching the downtown market, and for condos in particular, I would say if you were to total up all of the tenanted and vacant condos, it would be about 70% of what's on sale right now, which is
Ooh.
basically, so that's all investors, right? And I think that those people have already started feeling that
Yeah.
18-month lag that you were talking about a few podcasts ago. Like, I think we're there.
Yeah.
However, it seems like in terms of rates holding where they are, still seems to be up in the air a bit. Like, it doesn't seem like we're out of the woods yet. It seems like we're past the worst of it, but out of the woods, I wouldn't say so because overall, Canada is not like the States. We're not very productive, and inflation is a ratio
Yeah.
against measured unit of productivity. And we're not a very productive society. We are, especially not compared to the States, right? We don't produce much. We don't produce technology. We don't produce
Yeah.
at anywhere near the same rate as our neighbors do. So we're kind of just a really great place to park cash. And that's what people have been doing, coming from all over the world, parking cash here. And it's been great. And immigration has helped to pad a little bit of that inflation where the federal government is seeing, hey, we got to prop up the dollar because we basically deficit spent our way into a pit. And that doesn't seem to be stopping. In fact, we just seem to be getting taxed up the wazoo with carbon taxes and all kinds of ridiculous stuff.
Oh yeah.
But overall, it seems like there is still a real big possibility that inflation starts to come back to life if we don't get spending under control.
That's also true. Inflation is, we're not at the woods with inflation rate. I think that this is also partially why we'll probably, regardless of what the states will do later this year, we'll have to be very careful. Well, I say Bank of Canada, to be very careful with how soon they introduce rate cuts, because you could introduce rate cuts and let inflation get out of hand again. Right, so you don't want to do rate cuts prematurely, so you want to do them kind of like once things stabilize. But what does it mean stabilize in an environment like this? Nothing is stable about it. So you change, you just twist the knob a little bit and the whole thing goes out of whack.
But you said there was going to be blood in the streets, you think, coming this summer. Now, in terms of blood in the streets,
I'll explain.
Yeah, in terms of that, like, can't you just increase amortization and refinance somebody and bring those payments down?
Well, yes and no. Not to the extent that you'll be cash flow neutral or cash flow positive for those people.
No, but at least bearable.
Bearable, maybe. It's hard to say. Like
I'm just trying to play devil's advocate here.
So let me explain to you what I mean by blood in the streets in the summer, and that will actually help explain what I mean by a lot of the things that we've covered so far. So, you know, right now we're experiencing the spring market. You know, April 1st is here. We got April, May ahead of us. I kind of call June still the spring market because it still has the remnants of that same sentiment in a lot of cases.
For sure.
I actually consider March to be almost like a winter market because we're not entirely there. It's like right on the cusp, and it feels weird. It like metrically doesn't make sense to be spring yet because nobody's out of the woods trying to buy properties aggressively. There's some activity, but there's still not the kind of activity that will clear the inventory that we have built up over the last, like, God knows how long, and that's continuing to build up over the next. Will continue building up over the next couple of months. So here's what I mean by blood in the streets in the summer. So I've had, in the beginning of this year, I've had like, I don't know how many, probably like 3,000, 4,000 of pre-approvals, of which only a quarter may have materialized into transactions that actually closed or about to close in the next couple of months. So that's all the demand, right? That's all the demand that's holding up. It's there. It's waiting for something. It doesn't know what it's waiting for. I posted something on Instagram the other day where I wrote, buyer sentiment. Yeah, I'm interested, but I don't know if it's the right time yet. That's kind of what that 3/4 of the buyers are feeling. And that's the same people that when the market was doing really well, they were losing their mind because they felt that they were about to miss out on something great, right? So I call this segment of the market, these people more affected by the media and the general sentiment. The one that already bought and made their choices, they are a lot less affected by the sentiment because they're not paying attention too much to the ambiguity. They're paying attention to what's in front of them, which is a really good way of doing anything, real estate, business, whatever. So at the beginning of this year, I was of the opinion that when the spring market comes, this whole cohort of people that have been just sitting there and waiting will just go out and buy something, right? But because there has been like such ambiguity about the interest rate maybe continuing to increase, maybe not continuing to increase, there is all this talk about inflation and unemployment rate and et cetera, et cetera. And so a lot of them chose to do nothing for now. Now, they are waking up to the idea of wanting to do something now that April is here and they've seen March numbers and they're noticing there are some deals that went and they like those numbers. They like seeing properties that are selling below asking price or below what they're used to seeing. And one of the examples was the gentleman that I was talking about earlier who was looking to buy a house in Chatham, and I slowly convinced him to consider maybe condos in Kitchener, because if you looked at condos in Kitchener in the peak of the market, you were buying 600 square feet for like $500,000. You can buy the same for about $350 to $399 right now. These are the dynamics that people are going to be seeing, and they're like saying, "Oh, wait a second, like maybe I can go and try that." But when, right? They're not placing offers just yet. They're still guessing. They're still thinking. And the ones that were decisive have made the decision and they bought. And that's just my book of business. There's other brokers and people out there who are also dealing with the same probably general sentiment between the buyers that are coming to them. The ones that are decisive have either already made the decision to buy and have already bought, or will make the decision in the next couple of months, and that cohort will be gone. You will have a bunch of people who are not sure, right? And then what's going to happen is the summer market is going to arrive, and then all those people who were decisive about what they wanted to buy and when they wanted to buy it won't be there. So you have a bunch of people who are going to be renewing their mortgages in the next few months who will realize that their rentals are not cash flowing. They'll be thinking about maybe it's time to sell and list, which will produce another wave of listings. The people who have bought, who have been decisive, are gone. The only ones that are left are the ones who are indecisive, and they're going to continue being indecisive for as long as it makes sense for them. And then what you have is you have this summer market, which naturally is slow. Like summer market isn't always that active. We have like an active April, May, March, whatever, like the Labor Day weekend passes and the market picks up again. But summer generally is like, okay, like it's there, it's better than winter, but it's still not, April, May, and it's still not September. And so you're going to have a lot of probably inventory popping up in the next few months. You're going to have a lot of indecisive borrowers and customers who are not sure if they want to buy anything, and probably worse situation on the MLS than you have today. And then some of it will clear before again, by around the Labor Day weekend. But then again, you'll have all this left over inventory. And then again, if the interest rates are not improving in a meaningful way, you're not getting another wave of buyers. Like you're getting here and there are some that are waking up and starting to appear on the market again. But like I was of the opinion, I still am, that the first wave of buyers this year, 2024, will be your best shot as far as selling, because they'll be emotional. The ones in the summer will be less emotional, will be a lot more calculated. And the ones that will come in the fall market will be kind of a combination of both, because some of them will feel like, oh, maybe I'm missing out on something. Some will feel like, oh, maybe I shouldn't even be entering it anymore. I don't feel like I lost my opportunity.
I feel like there's a really good explanation in there for investors, because the investors that I'm seeing, that's what I'm seeing downtown. I'm seeing that motivation is clearly laid out for you there just by looking at occupancy. You can see if it's tenanted or if it's vacant. Immediately, I know it's an investor, right?
Yeah.
Talk to me a bit about primary residence, in terms of that market and how those renewals are going to affect them, because I see things from a totally different perspective. You're actually looking behind the curtain. You're somebody who's seeing someone's level of motivation. When I'm searching for a buyer, we're looking at listings, and if the agent who's representing that listing is good, they're not going to let me know what the motivation is. And that's when it gets a little bit obscure and you just see a market from a bird's eye perspective, and kind of looking at that, it's hard to tell, is there going to be blood on the streets because these people are in this situation? I work primarily in York region, a little bit of Simcoe. So I kind of see a lot of primary residence, and what happens there is very simple. It's usually just someone's looking to sell. If the agent's good, you're not going to know why, and that's going to be it. You're going to have buyers dictate the market in that case because you just don't know. So talk to me a bit about those renewals with a primary residence, someone who's holding a detached home in York region. What does that look like? How's that different?
It depends. Like the reality of it is that most households are over leveraged in terms of how much debt they owe in general. So, if you drive down most neighborhoods in York region, not everywhere, but a lot of the time, like when you drive through a neighborhood, you'll see very well maintained homes, like newer cars in the driveway, like nice landscaping. Everything is mostly fixed for the most part, right? If it's like again like a nicer neighborhoods you're looking at. And then when you drive through those neighborhoods, do you ever wonder? It's like, is everybody here really that wealthy, or is it just a front? Because the truth to be told is that most households live on a very, very edge of what they're able to afford. So that raises an interesting question. Well, what happens to those households where the edge of what they're capable of affording moves, and their income and their overall financial picture doesn't, right? And what could be a catalyst for that? Well, like a renewal at 5% or 6% could be a great catalyst of moving the goalpost. So all these years you were comfortably fine, making $300,000 a year or $400,000 a year as a household, now all of a sudden that's not enough, right? So like a good example would be, so what, let's say you had a mortgage of 1.85 million at like 3% all these years, and then now the renewal comes and it's, let's say, at 6.5%. That's like about 12 grand per month in payments, right? And you're going from probably, I don't know, 8 or 9 or something, maybe even less than that. I would have to do the math on this. But let's say it's an extra 4 grand per month that you just never had to pay. I mean, you had other expenses, you had like your vacations planned, you had your toys, your car lease for the new Mercedes was like $1,400 per month. And now your lifestyle has to change. In some cases, that's what happens. Lifestyle changes, and so people get a lot smarter about the way they live their day-to-day lives. They get rid of that $1,400 Mercedes lease. All of a sudden their vacation budget for $10,000 for that year ends up being their mortgage payment budget for that year. And so naturally, a household that's smart about adapting to the environment and to the times that they live in will do those things. That happens, I don't know, 3 out of 10 times. Unfortunately, 7 out of 10 times it doesn't happen, right? Because people will live in denial for years, sometimes months, sometimes it takes a little bit less. But they'll live in denial thinking that that's okay. They'll say, well, that's fine. Like, we'll just make a little bit extra money. And in some cases, that's also okay. They can. Maybe they run businesses and they can just take an extra 4 grand from the business per month, and the problem is solved. But let's say that's not the case. Let's say they've been literally living, they're working on a payroll, income is phenomenal, but they've been living at the very edge of what they're able to afford. This is where, if they have equity in the property and they've been able to pay down their mortgage and the property values have been improving and they haven't been borrowing against their property this time, this is where they would talk to somebody like myself and say, hey, can we get a little bit extra money to do this, this, and that, to consolidate some things? Plus, we're a little short on payments per month because of the renewal that's coming up right now. Can we patch up the hole in our budget for the next year or two until interest rates subside? That works. Like, that works quite often. It doesn't is if you've been remortgaging your house every year and now you come to a point where you are at the very limit and there is nothing else to borrow, and this is where you either change your lifestyle and you adjust, or you don't, and eventually those things just pile up and they get out of control and you list it anyways. But by then you'll probably in a much bigger hole than you started with, because remember, if you're out 4 grand per month, 1 year goes by, you're out 50 grand that you didn't have in terms of your monthly payments and your budget. So those households will have to adapt or probably sell. And then if they have to sell, then they have to sell typically, if they have a little bit of time and room in their savings to sell comfortably, that's great. But there will be some panic sales, right? So there's some people who will just panic and they'll try to get rid of the property. as soon as they can. And businesses also, like I'd say, business people who didn't have a good year at 2023, right? They're maybe in more debt than they were the year before. Also coming right now for their mortgage renewal. Like all those renewals that are happening right now in the next 2-3 months are going to be very painful for those that have not felt the rate hikes since they started.
And that brings me to my next question, I guess, for you. For people who do need to sell, there's a buyer out there for every seller eventually.
Mm-hmm.
I tend to work with a lot of upsizers or people who are making lateral moves, usually families.
Mm-hmm.
In that regard, there's always a huge question and fear around whether someone should buy first or sell first. Because obviously on one end of it, it's like, if I sell first, I'm going to be scrambling to buy something. And then what if I don't find something that I actually like? And then I settle for something I didn't like. And then the whole thing was useless. And I just racked up a whole bunch of expenses for no reason and a huge hassle. And like my wife is going to kill me or whatever, right? The other side of it is if I buy something, the market has been extremely volatile over the last couple of years. If something changes, we're in a very fragile state.
Mm-hmm. Yeah.
What if I can't sell then? So in terms of that, from the financial side of things, because that's your expertise, what would you tell somebody to do?
Well, if you gotta sell, you gotta sell. If you're downsizing and you gotta sell because you're trying to consolidate, or you just have unaffordable mortgages.
I mean, if you're a buyer,
if you're just looking for,
well, if you're somebody who would be interested in purchasing something where somebody is over leveraged, like for every one of those sellers, there's going to be a buyer and they're going to have that burning question.
I see what you mean.
Right, there's inherent dangers there, right? And which do you think ends up being the more dangerous side? Like holding two mortgages. I mean,
well, yeah, I think the selling part is the scary part, because you really can't count on your home to sell for any one specific dollar figure. Like right now, anybody who is buying is not buying to buy it at the face value. They're buying to get a deal. Like I haven't had a single customer come to me and say, "Oh, I can't wait to go out shopping and place an offer at the asking price." They're all looking for a deal. They're all looking to place a little bit below asking price, see what they can get away with. Very few are looking at it like in a way where they're looking at it as an opportunity at buying something that they really, really like. A lot of people out there are looking for deals right now. So like if you have a buyer who is looking to buy, I guess the question has to be first is like determine the motivation for that purchase. If they have a sale to make first, if they have to first sell their property, always sell first. Because again, like I said earlier, if you buy something and then you can't sell it for the price that you want and you can't predict what that price is, your numbers for the purchase may not make sense.
What happens in that case?
Well, your purchase will fall through. Like it's not impossible that it might fall through. If you have enough down payment, it's above 20%, you'll still close. It's just that like the question becomes, well, why doesn't the purchase make sense? What changed? Well, let's say you are selling a property that you have and you're expecting $400,000 from that sale. Okay, fine. And then let's say you're buying something worth 1.6. Well, $400,000 at 1.6 is like a very large portion of the down payment, but really at the same time, when you look at at really what it stands for, that's about 25% of it, right?
Yes.
Yeah. So 25% of 1.6 is a fair amount of down payment. What if you get 350, not 400,000 from the sale of your home? Can you still purchase the 1.6? Well, you still can, because you only need 20% down really to qualify in most cases. Does it change your calculation on the mortgage? Yes, it does. Chances are, if you make a lot of money and that change, because now you're borrowing a little bit extra money and you have a little less down payment, if it doesn't materially impact your application, it will still work fine. It could also be that it does affect your application materially, because now there is less down payment, more debt, and now you're going from, let's say, a tier A lender, like a TD or a Scotia, to a tier B lender, maybe like an Equitable Bank or a Home Trust Bank, right? What's the difference? 1% interest rate. That's it. How horrible that is to you, I don't know. right? To somebody, they're going to say, well, 1% in the interest rate for what? For the 1.2 million is 12 grand. What do I care? It's like, sure, good point. How much are you saving on the purchase that it's so fantastic? Well, I'm saving over 100,000 by going in on this purchase right now before I sell my home. I'm okay with, selling my home for $50,000 less than I expect. And that's fine, right? It just all depends on how much risk the person who is making this question or asking this question, how much risk tolerance do they have? How much room do they have to make an error? Because if let's say if it's somebody who is working on a very tight budget and they need to get $200,000 out of their condo in Toronto so they can buy this house worth $1.5 million, because they don't have any extra down payment, that is all the down payment they have, and they have a little bit of savings, but that's just enough for 20% plus closing costs. What is the cost of getting $20,000 less on a condo sale? Well, the cost is you can't close the purchase, right? Because it's $20,000 less, and all of a sudden you don't have 20% down payment, and now you have to be an insured purchase, an insured mortgage, and now it just doesn't qualify at all. So then all of a sudden the whole thing just is worth nothing. So it could be quite dangerous. So it's kind of split into two. So can you buy first before you sell? Yes, you can. What are the conditions? You have to have enough room for error, right? If you don't have enough room for error, should you try to sell first before you buy? Yes, absolutely. Because if there's not a lot of room for error, you don't want to take a chance. It's the same thing I tell to first-time buyers who come to me and say, hey, I was talking to my realtor. I'm just going to go conditionless on this house. It was built in 1934. I feel good about it. And it's like, okay, calm down. That sounds fantastic. And I like the fact that you love this house so much. But what if, for example, this house has some sort of use of asbestos that I don't know about, you don't know about, but the insurer does. And when I submit, they're going to decline it. There's only 3 insurers in Canada. If all of them know about this asbestos issue there, and you don't, and I don't, and this hasn't been disclosed, and maybe the seller doesn't even know it, but the insurer does from 20 years ago when they got this file last, your purchase is worth nothing because we can't close it, all right? So it's like also, well, what happens if maybe you place this offer unconditional and you start looking for an appraisal? I order the appraisal because I got to get the appraisal, and you already went unconditional. There's no inspection. There's no condition of financing, and then I send in the appraiser. The appraiser goes in, takes a bunch of pictures, finds there's a crack in the foundation or something that is, or maybe there is mold in the basement, or maybe there is leaks in the roofing, and then all of a sudden the lender says, well, I'll give you the money, but first you got to fix it. And how much is that? $30,000. I'll hold back $30,000 of my mortgage. First finish the fix, I'll give you the difference afterwards. Like, if you're a first-time buyer, you don't have $30,000 to spend on repairs before the bank gives you the difference of funds. You need to be able to close it for what it is. So, would you ever take a chance as a first-time buyer to go without conditions? I wouldn't. I think that the room for error is nil. Right? If you're an investor or somebody who's bought properties before and you have $1 million in the bank and you're buying a property worth 1.3, you can go conditionless all you want. Like there's no way that we won't close this 1.3 with $1 million in your bank account because there's only $300,000 mortgage. Who cares about $300,000? You can get from a private in a heartbeat.
Now, when you're talking about the, I guess, room for error being so small,
yeah,
this kind of has created a ton of problems with fraud.
Mm-hmm.
It's just like instantly, especially out west, and we saw a ton of it in Brampton. Brampton was like horrible with this stuff.
The capital of fraud in Canada? Keep going.
Yeah, it was really terrible out there. And when things are so tight, when margins are so tight, people do that. They do turn to fraud. Tell me how much you've seen that in your own practice. Like how many times have people come to you and said, hey, can you kind of make this look nice? Can you, like, how often does that actually happen? Because it gets reported in CBC Marketplace, things like that. But, what do you actually see in your practice?
So I've built my practice around the fact that I would never do anything like that. I don't touch files like that.
No, but I'm saying I know.
But here is just, I guess, here's how they would happen to land in my hands. So it's often that people will get into these types of arrangements where they will have somebody do something for them, as you said, and then it blows up, right? Something happens, somebody gets caught, the person gets stuck with holding the bag essentially because they can't close whatever purchase they got themselves into. Or maybe or maybe they got a mortgage, and a year later there's an audit, and the bank finds out that the file was fraudulent, and then they just tell them to get their mortgage out of their book and give them like 30 days. Here, we found there is some inconsistencies. Please move it somewhere else. We don't want it anymore. So it's actually this would be the time when I would talk to someone, because they would come to me and say, hey, I just don't really know what to do. I was talking to my realtor. I was talking to a trustee in bankruptcy. I was talking to my accountant. I was talking to somebody that I know that you've helped before. Could you help me figure this out? I don't know what to do. And then I get a chance to understand what actually happened. And a lot of the time what happens is consumers are very unsophisticated in most cases. They don't really understand how fraud works. They don't really understand how mortgages work. They don't understand how, for the most part, any of this really works on the inside. And they don't have to. Like, as a consumer, you should be able to lean in on your professionals, right? I think that's fair to say.
Well, that's what lawyers are for. That's what professionals are for.
Yeah. So in a lot of cases, like, unfortunately, it comes from the professionals that would often lead them towards those solutions, right? Somebody who maybe is a realtor who is saying, hey, like, I know that you don't qualify, but I can still get you into a house. This is why you should work with me. I'll get you into the right people and I'll get it done for you. This is unfortunately the stories that I've heard, right? And then they'll get them into it, something blows up, and then everybody walks away and says, oh, I don't know anything about this, first time hearing. And then the person ends up sort of getting stuck with holding the bag. So what can you do there? So something people don't know very well is that all fraud, when it is caught, it is reported between the financial institutions. There is a special platform that financial institutions use, and when something gets caught that is inconsistent or fraudulent, it gets marked and it gets flagged. So once you're caught, everybody knows, right? Everybody knows. You go to CIBC knows. You go to TD knows. You go to Constantine, Pocket Mortgage knows. Everybody knows. You can't get rid of that record. So the truth of the matter is that when that happens, you kind of are stuck with the private world, because nobody is going to trust you. Why would they? You've been lying on your paperwork and your submissions, and you have to earn your trust back. All right. So in a lot of cases, it would be a matter of working with a mortgage broker, probably, to help you get the private financing, if possible, if there's enough equity, enough room and all that. And then proving over the course of a couple of years that you have learned your lesson and that you're not going to do it again. And then eventually coming back to lenders where you fully disclose this situation that happened and hope that they forgive you, and you have a broker who is eloquent and good enough at explaining the problem so that the lender can understand and they can make enough commentary and enough notes to justify what happened. That's unfortunately how ruthless, or maybe fortunately how ruthless, the system is towards fraud. It does not tolerate it, and it will not forgive you, right? At least at first. It takes quite a bit of time and quite a bit of effort to earn your forgiveness back.
So we're going to have a bit of a mixed market, I guess, is the story. Because on the one hand, we're seeing things heat up. On the other hand, margins are small. Mm-hmm. We have seen fraud. We have seen banks get fined millions of dollars out of the big five. And at the same time, immigration is pushing demand up through the roof. Those renters want to buy eventually. Mm-hmm. They're trying their best. Yeah. And that's where we see fraud coming out. Yet at the same time, renewals are coming up. And in your words, it's going to be a bloodbath in Q2. So
yeah. So just to cover the topic of fraud, just to put a big fat dot near the end of it, it is not going to be forever. Like, this whole situation, the way that it works right now, is only because we as an industry, as professionals, we as a community have not pushed the government, meaning the CRA, and the banks, or even just Equifax, like the credit reporting agency. We have not pushed enough for them to communicate. Right now, they don't communicate, right? And that's been one of the topics that's been brought up a lot on Twitter, like with a lot of people in my industry who are very vocal about this. They've been saying things like, why don't we have direct access from the banking sphere to the CRA filings, so that when you have to double check something, it's just a matter of clicking a button and then you click it and it's there. There is no opportunity for fraud when the system is bulletproof against it. Right now, the system is allowing for it, right?
Do you feel like that's on purpose?
Well, I don't think it's my place to say whether it's on purpose or not, but I think it's just it's very the federal government and the CRA are very reluctant to allow anyone into their world, and I understand why, because there's like a lot of privacy issues and so on and so forth, and like, your tax information and your tax portal has a lot more than just the information to do with your income, right? Like it has stuff about your kids and stuff like that, and like your retirement plan and et cetera, et cetera. So it's like, how do you do it so you don't give too much? So I think that's the issue why it's taking so long. And also, you have to remember that when it's a government agency in a country like Canada, there's lots of levels of bureaucracy before anybody gets to the bottom of any problem. So it is the nature of the country that we're in that things take time. I think that just as a community, as long as we continue putting pressure on the government and on our regulatory bodies and the Bank of Canada to improve these systems so that they are a lot more holistic in the way that I think the financial system works in tandem with the real estate market. But I think if we do push and we continue putting more pressure, eventually these things will come to reality. When there is enough buzz on the street about, let's say this, it was, what was it? There was enough buzz on the street with the fact that rent control is, not rent control, sorry, I'm looking for a different word. There was a lot of buzz on the street about how landlords are being unfair towards tenants with rent evictions, and now our liberal Canadian government is now introducing the new bill, right, suggesting that now they want maybe things like the prior rent rates disclosed to the new tenants when they're proposing a new lease. Like why is that happening? Well, because there's been enough pressure. Okay, well, if we continue with enough pressure on the topic of connecting the CRA data with the financial industry and preventing fraud from happening and moving into the future, again, I think that's possible. It just requires a certain amount of pressure from the community, both the broker community, the banking community, and the public. And eventually the government's like, you know what, that's a good idea. We probably should connect the two. So CRA, banking, you guys talk to each other, you figure it out.
So, I mean, obviously, I think that would be fantastic. Whatever we can do to get rid of fraud is going to be a great thing, because I see it on my end, right? Mm-hmm. When I'm helping buyers, especially, compete in this market, it's like, how many other offers are we competing against that shouldn't even be there? Right?
Oh, yeah.
And that would be such a fantastic thing to clean up. I guess trying to, put a bow on all of this and put it in a nice package. It seems like the market could go either way, regardless of the, renewals that are coming up that you see on your end that look ugly. What I see on my end is simply just supply and demand.
Yeah,
I see consumption rates, and I see consumption rates moving up even with increased supply. Having said all of that and everything that we've talked about today, do you expect that we're going to see a hotter market or a cooler market in the next 60 to 90 days?
I think that if the next rate announcement stays still, we'll see a very sober market in the next 2-3 months. I think that if the next rate announcement happens to be a discount of any kind, we'll see a very active market for the next 2 to 3 months. And I don't anticipate any kind of rate hikes, so I don't think that there's any reason to cover that. But those are the two driving factors for, I think, the buyer sentiment is going to be decided by the artificial summary of the risks and the benefits ahead of us through the Bank of Canada decision to raise, hold, or lower, right? So consumers are reading the news and watching the media, and they're being emotional about it. So when people are considering purchase, they're first emotional before they're logical. Just how it is, right? Like when you look at buying something that's exciting and shiny and something that you always wanted, the feeling that you get from wanting to buy it is an emotional feeling. it is never logical. You never look at a new car and say, oh well, this car is going to be super effective on gas. It has enough room for a baby seat in the back. In the back, it's really really low on brake usage because of X, Y, Z. Like typically, you look at a car and you go, that looks pretty good. I'm in, right? So same with real estate. Like when people feel, oh, like things are looking a little better and it's spring, and I like the idea of owning a property. And Bank of Canada held rates. I think I should call my realtor. Like that's the thought process. And so I think that to that extent, you will see more activity, I think, in the next 2 months, just by virtue of where we are in the year. And I think that you will see significantly less activity in the summer. That's just my 2 cents.
Wow. All right. Well, I know we were kind of like jumping all over the place, and it was good to hash that all out because I feel like there's so many different topics of discussion around all this stuff because that's where headlines are. Like that's what I see, and obviously it's all clickbait at the end of the day, right? It's like just trying to pump something out that people will read, and that's cool. But it does make for interesting discussion because that's exactly the kind of topics of conversation that happen with my clients is that they're asking me, hey, I heard about this or I read about that. Yeah. What can you tell me about this? What can you tell me about that? And on each side, on each topic, there is a whole, world to unpack of information that is happening on the micro and the macro. So Constantine, always love having you, man. Thank you so much for taking the time.
Appreciate it.
Coming in person.
My pleasure.
Where can people follow you?
Best thing is always on Instagram. Please add me at the Pocket Broker. You can also just look me up online. If you just type in the Pocket Broker on Google, it will probably just give you all the results. And would love to have you guys follow. Thank you.
Thanks, guys.